Hello YouTube friends, and welcome to Grow Money Seeds, a channel about building wealth and managing your money. Many options traders know that there are Greeks associated with options, but very few traders fully understand the Greeks. As mentioned in a previous video, options trading is a zero-sum game, so for every winner there is a loser. Therefore, to be successful trading options, it's important to get a firm grasp of the Greeks. Not understanding the Greeks is like playing a game of chess without understanding the rules, which would make winning extremely difficult. Right, let's talk about this. When I first started trading options, I battled to understand the Greeks and why they were even important. But after a while, things fell into place. I encourage you to take your time and to get a good understanding of the Greeks and their importance. So, what are the option Greeks? Greeks are the quantities representing the sensitivity of the price of derivatives such as options to a change in the underlying parameters on which the value of an instrument or portfolio of financial instruments is dependent. Or, in simpler terms, they are risk assessment metrics used to analyze different types of risk associated with an option. What are the different types of Greeks? For this video, we're going to discuss the four main Greeks: Delta, Theta, Vega and Gamma. What is Delta? Delta is one of the most frequently used Greeks and measures the rate of change of an option price given a $1 move in the underlying asset. Deltas of an option are calculated using the Black-Scholes model. The delta of a call option is positive and is between 0 and 1. The delta of a put option is negative and is between -1 and 0. For example, a stock may be trading at $350 and a call option may be priced at $39.55 with a delta of 0.78. A $1 move in the stock to $351 would change the option price to $40.33. This is calculated by taking the 0.78 delta and multiplying it by the $1 move in the stock, which equals 78 cents. This is then added to the original option price of the $39.55 to give you the $40.33. In other words, a trader would make more money as the option is now worth more. Conversely, if the stock price falls, the trader would lose money. Why do we use delta? One of the reasons for using delta is to help determine the probability of an option expiring in the money or the probability of profit. For example, if we look at an option chain and if we decide to sell a put option which has a delta of -0.3, this means the option has roughly a 30% chance of expiring in the money or has a 70% chance of the option expiring out of the money. Or, simply put, the probability of profit for the trade to make money is 70% at expiration. If we sell a call with a delta of 0.75, then the probability of profit is only 25% at expiration. The second way delta is used is to determine the directional risk and for hedging. A portfolio should be fairly well balanced, and it is important not to have too many exposure in one direction. If a portfolio has a positive net delta, then it would make money if the market moves up. If a portfolio has a negative net delta, then it will make money if the market moves down. A trader with a net portfolio delta that is too positive will suffer substantial losses if the market falls. Conversely, a trader with a heavily weighted negative net delta will lose if the market rallies. A good trader will sometimes try to find a bullish or bearish trade if their portfolio is not balanced. This will help to bring the net portfolio delta to 0 or neutral and reduce risk. If the market now falls or rallies, they are hedged against the losses. Buying a call will add positive delta. Buying a put will add negative delta. Selling a call will add negative delta. selling a put will add positive delta. For example, if a portfolio has a SPY position and the net delta is 0.29, the easiest way to hedge is to sell 29 shares of SPY, and this will get the portfolio back to a delta of 0. Another hedge is to buy a put with a delta of negative 0.29. Conversely, a portfolio might have a net delta of negative 0.5. A hedge would be to buy 50 shares of that same stock or buy a call with a delta of 0.5. What is theta? All option contracts have a set period of time, and at the end of their contract period, they may be exercised and become stock or expire worthless. Theta measures the extrinsic value of decay, or the change of an option price as time passes. Time decay is nonlinear and accelerates the closer an option gets to expiration and can be positive or negative. An option buyer will have negative theta as the contract loses extrinsic value or time value, which is bad. An option seller will have positive theta and the contract gains extrinsic value or time value, which is good. For example, if we look at an options chain and if we buy a put option on the SPY and it has a theta of negative 0.2, this means that for every day we hold the contract, it will lose 20 cents. The seller of the same contract would now be making 20 cents each day from time decay. Why do we use theta? Theta lets option sellers know how much money a portfolio will generate as time passes, and they will want this to be a positive number. The opposite is true for an options buyer. Since theta is nonlinear, studies have shown that the sweet spot for selling options is around 45 days to expiration, and for buying options, it's better to have a contract further out in time. What is Vega? Vega measures the price of an option in relation to the change in volatility. It is the rate of change in extrinsic value given a 1% change in the implied volatility. When people buy options, the volatility goes up, and when people sell options, volatility goes down. Vega can be positive or negative. Vega is the opposite to theta when it comes to time decay. The closer an option is to expiry, the less Vega will have an impact on the option's price, and the further an option is to expiry, the more impact it will have on an option's price. Vega is a positive number for options buyers, and they make money if volatility increases. Vega is a negative number for option sellers, and they make money if volatility decreases. For example, if we look at an options chain and Vega is 0.3, it is saying that if the price of the underlying asset goes up or down by 1%, then the price of the option will go up or down by 0.3%. Why do we use Vega? When Vega is historically high, or it has a high IV rank, then it is better to be an option seller, and when it's low, it's better to be an options buyer. Therefore, if we can find an underlying asset with a higher volatility than normal, we may want to enter a position where we are selling options, and the opposite for buying options. What is gamma? Gamma measures the rate of change of an option's delta if the price of an underlying asset varies by 1%. It is a delta-related calculation and an estimation of how sensitive the delta of an option is. Think of delta as speed and gamma as acceleration. Gamma is particularly high for short-dated options, and as an option reaches expiration, it can cause delta to be more unreliable. Gamma can be positive or negative. Typically, sellers of options will want to be negative gamma, and buyers of options will want to be positive gamma. Why do we use gamma? It is useful to know about gamma, as there's something called gamma risk or gamma week. During the last few days of an options contract, the option price becomes very sensitive to small movements in the price of an underlying asset. Therefore, it generally means we do not want to hold options to expiration, and taking profits earlier can lead to better returns and reduce risk. In summary, there are four main option Greeks. They are delta, theta, vega, and gamma. Delta is used to help estimate the probability of profit and also helps to balance and hedge a portfolio so we don't have too much risk to one side. Theta is used to determine how much money a portfolio will make or lose each day. Selling options with 45 days to expiration is the optimum contract duration to take advantage of time decay. Vega is used to determine the volatility of an option. When volatility is high, it is a good time to be an options seller, and when it's low, it's better to be an options buyer. Gamma is linked to delta and measures the rate of change of delta. Gamma is high towards the end of an options contract, so take profits and don't always hold trades to expiration to avoid gamma risk. Now that you have a better understanding of option Greeks, this will hopefully help swing a zero-sum game and put some of the odds in your favor. If you have enjoyed this video, then please don't forget to click the subscribe and the like buttons so you're notified when a new video is released. Thanks for watching, and I'll see you in the next video.